Speaking of alternatives with Keshav and Managing Director, Head of Product and Strategy at PGIM Multi-Asset Solutions. Emerging market debt is, by its nature, one of the more volatile and dynamic areas within the world of investing. On top of macroeconomic and geopolitical forces that drive the value of emerging market fixed income securities up or down, local currency volatility adds another dimension of risk and opportunity. Keshav explores the world of investing in emerging market debt with Mariusz Banasiak, Managing Director of PGIM Fixed Income.
I'm particularly interested to do today's podcast on emerging market debt strategies, given the myriad complexities investors in the space work through. One would be hard-pressed to think of a strategy where, in addition to the obvious shorter-term trading skills and granular understanding of specific credit risk, a manager needs to understand the global macroeconomic landscape, current and future geopolitical trends, and how all of this is interconnected over time. In short, it's a fascinating investment class with tremendous opportunities for those with the right skill set. So before we get into the meat of the subject, let's find out a little bit more about you, Mariusz. Talk to me about how you came to your current specialty area and asset management more broadly. What interested you about it?
Sure. I graduated college 20 years ago with a finance degree. And then I came over to PGIM Fixed Income doing portfolio analysis, first for the general account and then for emerging markets. I centered on finance in college because math always came easy to me. I also liked the analytics of it. I could have steered towards engineering. I actually thought hard about doing that. But I also like working with money, and that really stems from me being an avid online poker player in college. I literally would play online tournaments on a daily basis into the night. And looking back, I think that was a great informal training how to stay even-keeled in the face of risks. So at PGIM in early 2008, I got an opportunity to become an EM junior portfolio manager. At the time, my interest steered towards reading articles about the rise of China and the commodity supercycle. I was ecstatic at the opportunity. It ended up being a real baptism by fire, however, because we all know several months down the line, the world seemed to have almost ended, but it didn't end. We were all jumping for joy. But within EM debt, my interest was more geared towards the EM local currency debt space. It's a bit more quantitative and technical than credit, for example, so it suited my strengths more.
I love the poker analogy. I'm not sure how happy your parents may have been about this at the time, but it all ended up being for the good. I agree a lot of investing is about expertise in your specific domain, but it's also a lot about psychology, and I think it's really astute to draw your attraction to and what you learn from poker and adding to all of your quantitative skills. I love that. So if you had a minute to convince me there's an opportunity here, what are the key things you would say?
Sure. It's a very attractive area, largely because of the inherent volatility. And, that volatility comes from the frequent changes that we see in the political sphere in our markets. There are less checks and balances versus developed economies. There's more reliance on foreign capital to support economic growth. So it offers astute investors the opportunity to take advantage of inefficiencies, both positive and negative. We always like to say that allocators, in our view, shouldn't just focus on the long side in emerging markets. There are inefficiencies to capitalize on from the short side as well. So, for example, tension between China and the US is a major theme. It's been driving certain segments of EM debt for years, and it will continue to do so. This is seen as a risk, but it shouldn't scare people away, as some news media tend to claim. That's because there are winners and losers here and opportunities to exploit.
Emerging market risks and opportunities can shift quickly and substantially based on a wide variety of global factors. Investors need to stay current on numerous issues that can affect market conditions.
It's incredible how open-ended the variables and items you look at to make decisions on the long or short side of positions are that you're able to take in the strategy. Another thing we'd like to do here is to unpack a headline. We try to take a recent headline that's relevant to the topic at hand, and the one I wanted to explore with you today is the following: a challenging period for emerging market debt, or a golden opportunity? How do you react to that when you think about it through the prism of your investment mandate?
When I look at that headline, and as I look over the next 6 to 12 months, we think a less challenging and a more golden opportunity period does lie ahead. But a fly in the ointment is the US election. We think this will prove to be consequential for certain countries and likely the global macro environment. That's because there's agenda around tariffs, immigration, as well as foreign policy. But putting the US election to the side, the big tailwind is Federal Reserve rate cuts. And we have a soft landing as the highest probability outcome over the next 12 months. So what does this mean? One, funding costs are going to come down. And two, the US dollar, which has been very strong over the past several years, should be at best stable. This should effectively translate into easier financing conditions, not only for external debt issuers, but also for local debt issuers. This is because EM central banks' cutting cycles are likely to gain momentum because inflation is well behaved, and that's been the case for about a year. This setup then presents local duration as one of the more attractive investment opportunities in EM markets. When it comes to currencies, the lower funding costs and easier financial conditions are going to support growth. So this should lead to select higher yielding currencies doing well. On the EM external debt side, the opportunity exists in select higher quality credits across sovereigns and corporates, mainly rated BBB and BB. Many of these credits have been very resilient over the last several years in the face of shocks like the higher interest rates as well as the Ukraine conflict, but they still offer very attractive spreads and yields in our view. There's also opportunity in select distressed issuers, countries like Pakistan, Egypt, Ecuador, and some countries in sub-Saharan Africa. Some of these issuers' prospects have improved because they've gotten a lot of durable multilateral and bilateral financing arrangements over the past couple of years, while others have restructured their debt. So if one hasn't followed EM over the past several years, we've been through a pretty severe distressed default cycle in sovereign space. And this is partly due to the end of easy US monetary policy that really started in 2017. But it's also partly due to these countries running a lot of macro imbalances. But now the Fed is set to end quantitative tightening and deliver the interest rate cuts. So we see very little risk of a renewed default cycle in emerging markets. On top of this, EM countries in aggregate have less macro imbalances than they had before. They have healthier external balance sheets. They have lower to stable debt to GDP profiles and also higher foreign exchange reserves.
With a new era approaching for these emerging markets, skilled investors need to have a strategy that encompasses broader macroeconomic trends and can zero in on country-specific economies.
Let's dig in a little more. Where would you say are the real focus areas for you? You've hit upon some of them. What are the opportunities and challenges in the space? How do you think about working through these?
Let me start with a country-specific opportunity that has us very excited at the moment, and then I'll touch on broader trends and issues that we are focused on. So the country opportunity is Turkey. We are long the Turkish currency right now. It's one of our bigger positions. And this is really the first time as a portfolio manager where Turkey's fundamentals are actually improving. That's 16 long years. And that's really thanks to President Erdogan finally taking a back seat, being democratic and allowing institutions to implement orthodox policy. It's a high reward opportunity to be long this currency because yields are north of 40%, 40, but it's also high risk since unfortunately in the past, President Erdogan has followed a pattern of negatively surprising investors by meddling with institutional integrity. But we think the times are finally changing. One of the positive broader structural trends in EM, despite the large diversity of countries, is the maturation of EM economies. So what does this mean? For one, it leaves EM less susceptible to global shocks. This is because debt structures are more sustainable. Issuers are issuing debt more in local currency than in US dollars or euros. Also, EM's share of the global GDP pie continues to grow as these economies become more diversified. So all this is translating into an improving rating trajectory for the asset class. And for investors, this should result in improving risk-adjusted returns. Another positive broad trend that we are focused on, this is a well-known trend, the reorientation of supply chains away from China due to tariffs. This obviously benefits a number of EM countries, but what is less talked about is the potential adverse effects of this trend as it relates to US-China tensions.
Because China is such a dominant part of the world of emerging market investing, it can have an outsized influence on overall returns within the asset class. That helps to underscore how valuable it can be for investors to be able to short Chinese assets if that's where they believe the best opportunities are.
Trump, it's highly likely he's going to implement more tariffs in China. So China may retaliate by raising tensions with Taiwan. It may also loosen restraints on interference in US elections using tactics like AI-enabled disinformation. So all this makes the situation ever more hostile. And this makes us quite pessimistic on investment returns on many Chinese assets, particularly the Chinese currency. So there's an opportunity here for our hedge fund to position in Chinese assets on the short side because we think there's a high likelihood that Chinese assets in aggregate are likely to underperform other countries' assets or other regions. As for the challenges, so near-term challenges include the three main known unknowns. In geopolitics is the potential escalation of conflicts in Ukraine and the Middle East, and in the US, the November election. So how are we managing around these risks? Since markets have behaved very well amidst these potential risks so far, and we have benefited from declining risk premiums over the past several years, from a top-down risk-taking standpoint, we are not aggressive. It's a lot more modest. And from the bottom up, decisions in our portfolio include not owning Israel assets, and we are also measured in exposure to the Middle East. And then away from the Middle East, we also have exposure to Mexico, but it has come down over the past several months because given the likely volatility stemming from a Trump presidency, we want to have more room to add to that exposure if volatility does rise over the coming months.
I'm particularly sensitive to the point you made about the maturation of emerging market countries. In many ways, the emerging markets have come a long way from the past histories of cyclical downturns. We have distribution teams across PGIM. They all have their ears to the ground with clients. And for each of these podcasts, we ask them to gather questions from the floor. I want to go through a few of these with you. Number one, the direction of the US dollar is something that affects emerging market currencies greatly. What is the anticipated direction of the USD in the coming months, and how should investors position themselves with opportunities and risks from that?
One of the bigger tailwinds for emerging markets over the next several months to possibly years is that the US Federal Reserve is going to be cutting interest rates. And you would think that automatically means that the dollar is going to trend weaker. But we believe that it's likely going to be very nuanced. The dollar should be effectively stable in trade-weighted terms because we don't see the Federal Reserve cutting rates so deep that the dollar loses its advantage in the interest rate differential. We think some Asian currencies are likely to underperform the dollar as a result of that. So countries like South Korea, Taiwan, the Chinese currency will still have lower interest rates than the US in our view. But more importantly, many of these Asian currencies are sensitive to the economic growth backdrop in China. And we all know that that backdrop continues to be quite challenged. So we think without an aggressive growth impulse out of China, Asian currencies are unlikely to outperform the dollar. On the other hand, though, there are select currencies in Asia that should benefit from supply chain reorientation away from China. Countries like Indonesia, India, and the Philippines stand out. And of course, Mexico should continue to be one of the bigger beneficiaries of the nearshoring trend. As a broad statement, however, as long as the US has a soft landing and China remains economically challenged, it is hard to see any significant broad dollar weakness, even in the face of the Fed cutting interest rates.
Thanks, Mariusz. You mentioned some of the Asian markets and how the dollar has an impact on them. The second question is about Japan. Japan is obviously not an emerging market country, but it does have a large impact on Asian emerging markets and Asian markets more generally. So how has the substantial depreciation of the Japanese yen affected opportunities in places like South Korea, Taiwan, and China?
Yep. Let me first say a few things about the Japanese yen before I talk about any impact on those three countries. I think everybody knows that the Japanese currency has had substantial depreciation. Since COVID, it has lost 35% in value versus the US dollar. That's substantial. In trade-weighted terms, the yen is one of the cheapest currencies in the world. Normally, you don't see that in a developed market currency because there are many other emerging market currencies that are cheaper, but the Japanese yen is right up there. And this is really thanks to the Bank of Japan over the years just running the loosest monetary policy in the world. And it was really exacerbated by the fact that they were running very loose monetary policy, doing quantitative easing, not hiking rates, while pretty much every other central bank since COVID has embarked on a hiking cycle. This incentivizes investment capital to move away from Japan and for foreign speculators to engage what is coined the carry trade. However, right now, this seems to be slowly reversing since the Bank of Japan has ended quantitative easing and they've been steadily hiking rates this year, while the rest of the world is seemingly now moving in the opposite direction. So how has the yen depreciation affected opportunities in places like South Korea, Taiwan, and China? It really hasn't had much of an impact for us anyway. So if I give you one stat, all three countries are major trading partners of Japan. You know, the percentage of their total exports going to Japan are in the low to mid single digits, but trade is really dominated with the United States and Europe. And that's why all three countries can be sensitive to currency moves against both the dollar and the euro. We have benefited from being long the dollar against all three of these countries over the last several years, but the investment thesis was not related to a view on the Japanese yen.
Interesting. Well, Mariusz, as I suspected, this has been a really fascinating conversation, and for me personally, a real eye-opener in terms of the investment approach you and your teams take in emerging market debt. Thank you so much for being with me today. Very much appreciated.
Thank you very much. Appreciate it.
All right, so let me wrap this up with my three key takeaways. Number one is that the local currency emerging market debt strategy, when managed with the right expertise, can be extremely reactive in taking advantage of all sorts of market inefficiencies stemming from both positive and negative events. With the ability to be either long or short a situation, a manager can capitalize on distress as well as growth. Number two, it's hard to overstate the breadth of variables that an emerging market's local currency debt manager has to analyze and track simultaneously in deciding on an investment from all of the major geopolitical trends to specific government policies to national and regional economic health across both developed and emerging markets. Not to mention currencies, interest rate, and specific issuer credit risk. And I'm just scratching the surface of the different potential variables. And number three, those of us who invest globally in developed markets are keenly aware of the influence of the US dollar's de facto status as the world's reserve currency, as well as the role US-China relations play in making an investment decision. But these factors, along with US economic policy and economic health, is multiplied by a pretty significant factor when investing in emerging markets. So with that, I hope you enjoyed today's conversation.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2024. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.